Rex Sinquefield is Chairman and Chief Investment Officer of Dimensional Fund Advisors. Rex received his BS from St. Louis University and his MBA from the University of Chicago. He has contributed numerous articles to books, academics, and professional journals. Best known among those are the studies of rates of return, stocks, bonds, bills, and inflation, which he co-authored with Roger Ibbotson. He has received 2 Graham and Dodd Awards for best articles in the Financial Analyst Journal. He was one of the first to successfully apply the academic findings of modern finance to money management. In the early 1970s, he and his colleagues at American National Bank of Chicago pioneered many of the nation's first index funds. Rex is director of the German St. Vincent Orphan Home in St. Louis, Missouri. He's also a former trustee of DePaul University and is a member of DePaul's investment committee. Your childhood ambition was to become a priest, yet you left the seminary to study finance. Why did you do that?
Well, they're really separate decisions. First, I decided to leave the seminary, and I'm sure that the Catholic Church is much better off as a result. Then I went to St. Louis University and went into their business school for 2 years. I maintained a major in philosophy, but I really didn't get entirely turned on to the field of finance and financial economics until I went to the University of Chicago 3 years later.
What happened there?
There I really discovered what was going on in the field of modern financial theory and financial economics as it existed back in the early 70s. And what attracted me was the well-ordered view of the marketplace. And it reminded me very much of studying philosophy. The logic was very tight, it was very neatly ordered, and the empirical evidence supporting the theories and the models as they were being developed was overwhelming. And it was also clear to me that virtually none of this was being applied in the real world, and I decided, I think in probably the first or second class I attended, that I would take every finance course I could and would look for an opportunity to apply that when I got out of school. And as fortune had it, things sort of went my way after that.
At the University of Chicago or in other places, did you have a mentor?
I wouldn't say I necessarily had a single mentor. You always looked up to your teachers at various places. So early on, I was most impressed and inspired by Gene Fama and Merton Miller. When I went to American National Bank at Chicago, I was quite impressed by some of the bosses that I had then. Here was an organization that no one had ever heard of outside of a few blocks of downtown Chicago. And yet they gave myself and a few other people the opportunity to develop what arguably is the first S&P 500 index fund, and went on to innovate a whole lot of index funds. And that put that bank on the map nationally, at least in the investment business.
Right. When you left the University of Chicago, you went to the American National Bank in Chicago, where you did start the S&P 500 index fund. You touched on it. Was that the first?
Well, you know, that's always a running debate between the folks at American and the folks who were at Wells Fargo. What we know for sure is that they both started in 1973, and by the end of '73, they both had about $25 million in assets. So both will continue for the remaining history of the world, will continue to say that they were the first, but I don't think anyone really cares.
Well, how did a newly minted MBA persuade your superiors at American National Bank to get behind what seemed to be at that time a radical idea?
You know, I've thought about that, and for a while I thought it was my impressive powers of communication and persuasion, but as I look back on it, I think also that I had some very wise bosses and superiors, and the management of the bank was actually very wise. They knew that they needed something in the investment business. What they had wasn't particularly effective. And they knew some of the academics at the University of Chicago, particularly Jim Laurie, who was a professor of finance there. And it was Laurie who persuaded them to bring in a couple of MBAs, let them run around the place, sort of listen to what they do, and apply their ideas if they had all make sense. And so he was a big help early on in continuing to persuade some of the senior management that, yeah, you really ought to embark on this path. You ought to go down this road. And it surprisingly did not take long. From February of 1973, when I first proposed this fund, to May, June, and July, when I showed that you actually through sampling, say, 100 or so securities could emulate the S&P, to September, we were up and running. So that's a very short period of, 7 months time from suggestion to implementation. That's remarkably fast for an institution that large, for an idea that was clearly very radical at the time.
As you embarked on this radical path, as you call it, what was the overall reaction of the investment community? And what was the community doing at large at that time?
Generally, the reaction was, well, first of all, everyone took notice. This got a lot of attention in the local press. It got attention in the national press. There were a few pockets of support. Of course, the institutional organizations, the big pension funds, were behind this to some extent. In each of these large organizations like AT&T, New York Telephone, they had their people who saw this as an eminently sensible way to invest. In the popular press, it was met much more with, at the very best, curiosity, but probably more accurately, hostility. And the people who were advancing these ideas were labeled as commies. It was un-American to pursue any investment strategy which strove for mediocrity. And as I always reminded them, mediocrity was a lot better than what they had been achieving to date. I also learned to, soften my rhetoric a bit.
Since that time, there's been an ongoing debate regarding the efficiency of the markets. Having been a big part of that debate from the beginning, would you give us an overview of what that particular debate is all about, and really how you were at the forefront of that debate?
Well, I was only at the forefront in the sense that I was a proselytizer, and understanding that argument and getting its message out was essential if we were going to sell anything like the early index funds. But the debate, of course, began in the academic world. At least one part of the debate began in the academic world at places like the University of Chicago and other academic institutions. And essentially the debate is about whether or not markets work. The academic evidence is important and persuasive for academics. A lot of it is not particularly useful in talking about investment products. And so much of the challenge that the early purveyors of passive investing faced was the need to communicate sometimes ideas that are couched in obscure, esoteric academic journals into plain English. And we learned to do that in the early 1970s. The debate amazingly continues to this day, although I think that the advocates of the idea that markets don't work, at least in any practical sense, they're hanging on by their fingernails, and we're going to all stand by and watch them drop into the nether region one by one.
How did you get the message out initially?
Initially, unfortunately, it was not a very big step from classroom rhetoric and classroom logic. And what we learned early on is debating on those terms doesn't work. You're talking to a board of directors or an investment committee. They're not ready and not prepared to discuss things in those academic terms. So we had to simplify ideas, and fortunately there was the development of data about the performance of investment managers that came from other organizations like A.G. Becker. And so the evidence, while not rigorous in a scientific sense, nonetheless was accurate. The message it supported was supported fairly and accurately, and it made it easier for us to convey the idea that in general managers can't beat markets, and the treasurers of corporations were beginning to see that with their own pension funds. And as firms like A.G. Becker started producing more performance reports, the investment community at large had to slowly, maybe not willingly, but slowly acknowledge that in fact most managers underperform the market. And that was the nature of the debate as it took place in the early and mid-70s.
It sounds like you had to be very patient with the message because there was no national forum to get this out to. It was one meeting at a time to build national awareness.
For the most part, it was one meeting at a time calling on corporations, but in the early to mid-70s, there were a lot of debates or discussions that were held by the trade press and industry-sponsored forums. So there was a lot of debating that took place. I know myself, I participated in a good number of sort of active versus passive debates and index fund type debates and discussions. There was considerable attention played by the trade press, particularly pensions and investments and institutional investor, focused on this topic heavily and constantly. So it's hard to imagine it now, but it was a raging debate in the institutional investment field. It was a very exciting time, but you're right, you did have to be patient. From the time we set up our fund in September of 1973, that's American National of Chicago, until July of 75, we got virtually no new clients. That was a period of 20 months. And the same thing was true for Wells Fargo in San Francisco. We both, in July of 75, had maybe 70 or 80 million dollars under management. This is after almost 2 years of marketing. And then the floodgates were opened when New York Telephone gave $40 million to American National. And that seemed to be the imprimatur. That was the stamp of approval that all the large institutional investors were looking for. They were the largest, I believe the largest subsidiary of the Bell system at the time. And that action sort of opened the floodgates for everyone else. And within 15 months, American National and both Wells Fargo had increased their assets by over $1 billion each. And this is in 1975 dollars. That's, it was real money back then.
Every study of past performance, Rex, of mutual funds indicates that active managers consistently fail to beat the market. Despite the evidence, many investors continue to believe the active managers do add value. How do you explain this contradiction?
Well, it's certainly a case of hope springs eternal. It's much more exciting to talk about active managers and who's holding the hot hands today. That is sort of the sizzle of the press. If there weren't those kinds of articles, then magazines like Money and Forbes and television shows like Wall Street Week wouldn't be able to exist. They feed on that kind of stuff. And in a certain sense, that appeals to common sense. Certainly in the case of sports, in baseball, a way above average athlete is going to get way above average results. There's no sort of market mechanism that causes that person not to retain his or her comparative advantage. The same thing might be true in certain intellectual fields, but it's not true in the market. A person that's more brilliant than everyone else will not be able reliably to earn higher returns than everyone else because the market process squeezes out any pricing imperfections, or at least tends to do that, such that there are no high expected return securities just sitting on the table waiting for the smart person to come and take them. So in that kind of market, it's impossible consistently to pick winners, just like it's impossible consistently to pick losers. So a market that works protects everybody, protects the little guy just as much as it prevents the genius from getting above average returns. But why it persists, I really don't know. I think once someone really gets the message, one, they have the answer about how to get good and decent performance, and two, it should free up their Friday and Saturday nights from burning the midnight oil looking for undervalued stocks. They can go out and engage in socially enjoyable activities.
So you're saying, too, that the genius of these stock pickers is actually already factored into the market?
Nobody knows precisely what causes markets to price securities and assets the way it does. Their opinions are factored in, but so are the opinions of 6 billion other people. And so the market is the only thing that possesses the implications of all of the information and insight and preferences and actions of all 6 billion people in the world. So you can think of the system of market pricers as a vast processing machine that takes all this information and brings it together. It's the only place where it's brought to bear. So you can have one individual who can be very, very smart and actually know a little bit more than everyone else. But does he know more than 6 billion people combined? No, he knows a tiny, tiny fraction of what is knowable and what's built into prices. That's sort of the intuition of why no one's ever going to get an edge over the market.
Do active managers do better in down markets, in your opinion, Rex?
Not that I'm aware of. I hear this claim, but I think that claim is as empty as many other claims.
Why is that?
I don't see any reason why they should do better. The argument that's made is they hold more cash, therefore they do better in down markets, but I've never seen that documented or verified anywhere.
After hearing the story, I do have to ask you this. Can you explain the performance of Peter Lynch at Fidelity Magellan?
Well, it's the case that after the fact, when you know who the big star is, if you look back over a 10 or 20-year period, you'll always be able to ask that question. Every 10 years, or every year, you can look back and say, who was the winner over the last 10 years? Now, how do you explain his performance? So that's kind of how to think about the process, is you have this huge distribution of managers, thousands of money management firms now worldwide. At the end of any period, just by chance, some of them are going to have very good returns and some are going to have very bad returns. You never get to interview those who have very bad returns because they leave the game. The very good returns, the managers who have very good returns, they go on talk shows and write books about how to pick stocks. And so it's a case of ex post selection bias. We know about Peter Lynch after the fact, so we ask, how do you explain his performance? And of course, you can never go back and explain an individual performance. It's kind of like anecdotal evidence. And it would be difficult scientifically to go back and explain how this particular portfolio did what it did. You would never be able to tell if that was due to skill or luck. When you look at the population as a whole, you can then answer that question. That everything seems to perform as if most of the superior performance and the bad performance is due to good and bad luck, respectively, which is what you'd expect in a system that works, in a system that's fair, or in a market that's efficient.
Does survivorship bias also affect this area?
Well, survivorship bias affects almost every commercial database of money managers like Morningstar or Lipper or any of the consulting firms who have databases. Can you define it
for us and then go ahead with the effect?
Yes, and there's nothing that these commercial vendors, I'm not trying to denigrate them in any way, they are victims of survivorship bias just as are the users of the database. Survivorship bias comes about when you have someone collecting the performance on, let's say, mutual funds, and now we have a mutual fund that has just had horrible returns. The investors start to leave and the fund has to liquidate and shut down. Now we look at the database of mutual fund managers, say 5 years later, and we're examining the performance, but the performance of that fund that died, that did so terribly, is not in that database. So the only ones we get to look at were the survivors, those who were good enough, regardless of how bad they might have been or how good they might have been, they were good enough to make it to the end of the period. But all of those that died before the end of the period are omitted, and for the most part, the returns of those funds are atrocious. In fact, we now know that if you compare the performance of all of the funds through time that you could have purchased, including all of those that died, compared to just the set that survived, the difference in performance between those two groups is about 100 basis points a year, about 1% a year. So that's a huge difference. That's the effect of survivorship bias.
Are all markets efficient, or do the active managers have a chance to do better in foreign markets or even with small company stocks?
I don't think their chances are any better in those markets than they are in the United States. These are both very popular claims. I've never seen any evidence in support of it, and in fact I am aware of evidence. There is research now going on about the foreign markets, so I'm aware of evidence that directly contradicts these claims. The markets seem to work just as well there, or said another way, managers don't do any better there relative to markets than they do here.
Mm-hmm. Rex, you're known throughout the academic community and the investment industry as the co-author of Stocks, Bonds, Bills, and Inflation, SBBI. What exactly is SBBI?
SBBI was a work that Roger Ibbotson and I started in 1972 or so, and had several articles published in the Journal of Business at the University of Chicago, followed by several monographs. And basically, it's just a study of the rates of return on the major asset classes in the United States. Back in its day, in the early and mid-'70s, in fact, even up until the early '80s, it was one of the few sources of reliable rates of return of the major asset classes in the United States. But in the last 10, 15 years or so, there has become available so many different time series that it's hard for anyone who, say, has been in the business only 10 years to imagine that there was a time when the rate of return availability was a desert, where nothing existed at all. And so it was the first long-run study of asset classes across the U.S., stocks, bonds, government bonds, corporate bonds, treasury bills, and inflation.
Whose idea was it to do the book?
Actually, the way this started was Roger Ibbotson was a consultant for the University of Chicago's Treasurer's Office, and I was working at American National Bank trying to write a little paper or monograph supporting the idea of investing in an index fund. And we both independently realized that we needed data to do the work that we were doing for our respective organizations. And Roger and I had kept in contact from our days on campus, and Roger was still working on his PhD at the time. And so we got to talking about the work that we were doing, and we said, why don't we pool our efforts? And Roger would do the stuff on the bonds, I would do the stuff on the S&P 500 and on inflation. And then we would have a memorandum that each of us could use in our respective organizations. And that's all we intended to do. However, Jim Laurie entered the scene. He got wind of what was going on and told us that we would both be speaking at the next CRISP conference. And so that created the challenge for us to come up with something that was much more worthy academically and scientifically. So we redoubled our efforts and produced the historical return series. And following that, based on an idea, a little hint from Fisher Black, came up with a way to provide a sort of a simulation methodology for creating the future return distributions for all of these asset classes. But that's how it all started. It's a simple desire to write a memo that each of us would use in each of our own organizations.
And this also helped you get your message out one meeting at a time.
Yeah, it did. There's no question that the publicity that work generated back in the early and mid-'70s was helpful to American National Bank and was helpful to me and to Roger too.
Rex, with the case for indexing getting stronger over time, what would happen now if everyone chose to invest exclusively in index funds?
Oh, that's like asking what would happen if everyone became virtuous. I don't know. It would be heavenly, I suppose. I certainly don't know what the economic effects would be, but it's not anything that's going to happen in our lifetime, despite the fact that we're now 25 years into indexing. Still, I think in the area of retail investing in this country, I doubt that there's even 1% of assets invested in index funds. In the large pension fund community, it might be as much as 30% of equities. And around the world, I'm sure it doesn't approach 1%. So it's not anything to worry about. I don't know the answer, but I know it's not one that we're going to need to know for another 100 years or so.
Nevertheless, are you happy about how far the message has come?
Oh yeah, very much so, and I would be happier if the word got out more to the retail investor, because they're still the ones that are victimized by the age-old myths about stock picking and the high costs that go along with that.
Based on all of your research, do you have any words of wisdom for would-be investors or advisors?
Yes, diversify your investments. Don't trade very much. Realize losses when you can. Don't realize gains. Write to your congressmen and senators and demand an elimination of taxes on capital and dividends and interest. It's an onerous tax, particularly at a time when most of the people need to save for retirement. And I think everybody should root for the Cardinals.
I have one last question for you. Where do you think the market is headed?
Well, I know where the market's headed. I just don't want to share that with anyone.